My screen for a second. And we are live. How's everybody doing today? First time in a while that I've had Mr. Baily on the live stream. Want to welcome him. He is with Client First Capital, which is a registered investment advisory firm here in San Diego. I may be answering questions about individual securities today. Loren Baily will not. People who are registered financial advisors cannot give advice to buy, sell, or hold any security via YouTube comments or live streams. That in a lot of ways is just kind of ridiculous. But I can talk about any of those later on in the live stream. We're going to talk about more globalized things today. Talk about global inflation, Fed policy, what we think is happening with the market. But Loren, why don't you go ahead and introduce yourself? Tell us a little bit about you. So now that I've given the disclosure, tell us a little bit about you, and then we can just start answering questions that come through on the live stream, and of course, just talking about markets in general. Go ahead.
Hi there. My name is Loren Baily. I am a senior wealth manager, Client First Capital. Been around and in the markets for over 26 plus years. Spent some time with JP Chase, but I guess most importantly, I've been around some of these bear markets, sideways markets. I've seen market crashes, not just one, but a few of them. And many of them have certain things in common, not just euphoria and then a bubble and then everything goes to hell in a handbasket. Sorry for.
Yeah, you can say that on YouTube. So
okay.
Hell is perfectly allowed.
All right. But one of the things that I see that's in tandem and could be in common with what we're going through now is that if we were to have a recession or even a market crash, which I don't think we will have, I do think we will have a recession, but a recession is not necessarily a bad thing, particularly if it's not extreme, but we can have a recession and a dip in the market versus a recession and a crash in the market. However,
right.
when there have been recessions or slowing of the markets, usually when people are saying, hey, the market's going to crash or the market's going to do this or that, there are people that are saying it and the reactions are immediate, but the effects and the actual event doesn't really happen until a year or two from when people first start jumping up and down and saying that the sky is falling. So, it may well be, hey, we're saying, oh, we're going into a recession. Oh, the market's going to do terrible, all of this stuff. It may well be that we have another year or so before we see the market go into a real malaise or drag, because keep into account, the Fed is raising rates to kind of stem off inflation, but it takes 6 to 12 months for the reactions of the Fed to really register in the economy and in the economy. The market is forward-looking.
Market is forward. A couple ways, though. The markets have already reacted. We're looking at interest rates rising, particularly on the short end here of maturities. Interest rates are much higher than they were just at the beginning of the year. Like 1-year treasuries, I think today they're at 4.09. I'm looking at the rate sheet here right now, the global yield matrix.
Right.
So 1-year treasuries at 4.09, 2 years at 4.14, and we go all the way out to 30 years. We have treasuries there at 3.61, which is an inverted yield curve. Normally, you have, for my audience here, you have your shorter end maturities with much lower interest rates than longer end maturities. Talk a little bit about what that generally means for the market. What usually happens with markets and the economy is when we see an inverted yield curve.
Well, keep in mind that when you're looking at these charts, be they the charts in the bond market or the equities or stock market, what you're looking at is a story that people are telling, and you're looking at a belief. So normally, of course, the longer you hold debt or hold money, the higher the rate, because people are paying you to hold money longer than they are in the shorter. So if it's reversed, where people are paying a higher rate on the shorter end than on the longer end, that's usually a telltale sign or a precursor of a recession. Right. So in the fixed income market, particularly, people are saying they're pricing in somewhat of they're saying there's going to be a recession. But keep in mind that this whole thing is a story around what people are thinking is going to happen next. Okay. So you've got two theories going on out there. Okay. First, we have the backdrop, right? We have COVID and all this stuff and all the money we pumped in because we had to halt our economy, and we put money into the economy to hold up our economy. And now our economy is back to normal, and we have inflation that's out of control and a lot of money in the system. So we're taking money out of the system, and inflation's still going high. So the Fed is going to try and raise rates to contain it, and it's better that they do that now than later, because if the economy really overheats, it may be too late before we really suffer some kind of catastrophe. Now, that said, there's two prevailing philosophies that are being heard right now. The conversations are as follows. One says we're going to have a quote-unquote soft landing. What does that mean? It means the Fed is going to lift rates just right so that the economy slows down just enough so that inflation is contained and the market isn't really harmed. Then there is another philosophy on the other side, is that the Fed isn't going to get it right. It's not going to be a soft landing. It's going to be a crash because the Fed almost never gets it right. Yeah. And a crash means maybe not a market crash, but it's going to be a harder landing in that the market's will come back.
Let's talk a little bit about what you mean by a market crash. Like, what do you mean? Because there are a lot of folks here who've never really – there's a lot of folks that watch my channel who are younger than I am, right, and you, and who have never been through a true market event like 2008 was. And you could even say like the dot-com crash really wasn't a crash. It was kind of a slow decline over 3 years. So 2008 was the last time we had a crash and utter panic. Talk about what you mean is what's the difference between what you think is a market crash and just sort of like a normal recession?
So a normal recession is usually a slowdown in the economy. Mm-hmm. Unemployment goes to a certain level, and growth slows. A crash is something that's very, very dramatic, where the stock market goes down thousands of points. It may go down 15, 20%, 25% within
usually in a couple of days, right?
Oh yeah, well, yeah, 25% at least in like 2 or 3 weeks or something like that.
Right.
And it either stays down there or there's some kind of a recovery pattern, whether it's a sharp V-shaped pattern where it rebounds very quickly, kind of like what we saw recently here with the pandemic crash, right, or whether it takes a long time to recover. But there are things in business called market cycles, and that is basically there are ups and downs. So there are times in the economy when business and the markets and everything else is going just great. Then we hit kind of a peak, and then we have to come down because inflation gets too high, and there are times when the economy needs to be cooled off a bit. Right. These are market cycles. They happen over and over again. And we've kind of got spoiled in probably the last 10 years or so, and that we just think that our economy is just supposed to grow and there's supposed to be happy times all the time. No, the economy overheats and sometimes it needs to slow down. And that's kind of where we are now. So, and it's due to the pandemic and the Fed putting a lot of money into the economy. But also just know that a recession, even though it's being kicked around in the news, in the media, that it's going to be a horrible thing, it's not necessarily a horrible thing because by definition, a recession really means kind of a slowdown in the economy. Now, there could be various types of recessions. An extreme recession could result in like I said, a market crash where the markets really go down big and lots of money is lost over a short period of time. But that does not have to be the case.
Right. Yeah. No, that's some of the things I've been trying to impress upon my subscribers, my audience that watch these type of videos, is that we do have a normal ebb and flow to credit cycles and business cycles here. And I've been of the opinion that this expansion from 2008 until June of this year, February of this year, that probably should have ended in 2018 when the Fed started raising interest rates then to cool down the economy. And while they were raising interest rates, that's when fiscal policy on the government end went crazy, and they started deficit spending like crazy back in 2017 and cutting taxes. But that probably should have been the normal end of the credit cycle, and we extended artificially because of fiscal policy into 2019. And then when the pandemic happened, of course, we just started printing money en masse. Now, I think what's happening right now is kind of a combination of the natural end of a credit cycle, hangover from pandemic assistance, mostly to businesses, not really to individuals. It's not the $3,000 checks to individuals that went out. It was the billions upon hundreds of billions of dollars that went to businesses that was forgiven. It's not the $3,400 that you got, because you're a citizen of the United States. That's not the cause of inflation. But a large part of what's going on too is the combination as well as supply shock. I mean, most inflation events are actually precipitated by supply shock, not by printing money. And this is one of the narratives that gets stuck in people's heads that they can't get rid of. And when I ask them, I'm like, what's your evidence that printing money causes inflation? Like, how is it correlated between all of the different other inflation events and what's going on right now? Generally, they can't find that correlation, right? And then on top of those three things too, we also have oil. And I think oil and the war in Ukraine, and then somebody here, Michael Will, mentions how much worse could things get when the Strategic Petroleum Reserve release ends and the U.S. has to restock. Our releases from the Strategic Petroleum Reserve really aren't that large. It's like 1 million barrels per day. So it's not that large, guys. And the Strategic Petroleum Reserve was full like back in 2014, 2015, sometime then. So releasing that oil and then buying it back at, right now we're buying back at $80 a share, possibly $100 a share later. It's not going to add that much more to demand. The demand for oil has increased dramatically since the end of the pandemic, and people started going back to work and demand started rising again. All of that is contributing to global inflation. So the thing that I'm looking at when I look at global yields right now, though, is we do not see, the last time this happened, it was really on the back of the Federal Reserve to do it, because back in the 1970s, it wasn't just supply shock that created this. It was also currency pegging, where we had foreign governments who were holding billions upon billions of dollars in cash, physical cash, in safes out of the country. And that was literally sucking like physical dollars out of our country and necessitated printing, as well as we had an oil supply shock there. This time, things are a little bit different. It's not just an American problem. This is a world problem. And yet we have countries like Germany and France where their 30-year bond rates right now, because of how the European Central Bank is working and how they are issuing debt, their 30-year rates now are, Germany's under 2% and France is under 3% on 30-year bonds. I think this is part of that is due to market forces, but I think that they run the risk right now too of not coordinating actions closely enough with the Fed, and it's going to cause us even more issues when it comes to controlling inflation in the long term. I think this is a long process, Mr. Baily. And I think it's not going to be over anytime soon. I think we don't get relief by Christmas. We don't get relief by next summer. I think this is a multi-year process to work our way out of this.
So let me ask you a question. What do you think is, what do you define as relief?
I would define relief as inflation going back to under 3%.
Okay.
Right.
Relief in the inflation numbers.
Yeah. So we don't want, of course, deflation.
Right.
And we don't want inflation really to be under that 3% level, because then we're actually going to be outcompeted in terms of exports because of the way the dollar works. We definitely want to devalue our currency over time, so we still have the ability to export. But a couple of things happen right now that are just not working in our favor when it comes to Fed policy and controlling inflation. The U.S. was really quick to weaponize the dollar in the Ukraine conflict, really, really quick. And it made the dollar a really attractive investment. And now people are buying up, U.S. debt because the yields look really good. This is kind of an issue, man. It's kind of an issue. This is kind of the opposite effect of what the Federal Reserve wanted in a way, and that's government policy interfering with monetary policy because they don't necessarily coordinate all of their actions. But it's also the market too. The markets are fleeing to, they're not fleeing. Their money's not fleeing to the United States because we're the best. It's fleeing to the United States because everyone else looks worse, right? And also our interest rates are a little bit higher too. But as everyone else starts to raise their interest rates in order to keep investment dollars from leaving their country, I think that's when we finally start to see normalization. Is when all of Western Europe is on the same, and Eastern Europe is on the same page in terms of interest rates. When we get China in the mix as well, there's just a lot more moving parts in this inflation event than there have been in prior inflation events.
I have to wholeheartedly agree with you. I don't see any relief in that formal definition coming. I mean, definitely not before year's end. There's just too many moving parts, as you said. Yeah. Let's look at China alone. China's rates are fairly low, and it may work for their little insular economy. Little insular, it's one of the largest top 3 economies in the world. But here's the thing. I mean, they're still dealing with the pandemic, and they deal with it on a different level than we do. When things are spiking in our country, what do? We tell people to wear masks and get vaccinated. Okay, over there they don't do that. They just shut down parts of the country. They will shut down cities block by block, and what does that do to their business? What does that do to the overall global supply chain?
Yeah, and they don't have PPP loans and EIDL loans and things like that. What is that doing to their businesses?
Right, and they're focused on their people and not business, which is fine. But when China is so intermingled with the global economy and producing products, and they're not able to produce because part of their country, a good part of their country is on lockdown, that is another factor which interrupts the supply chain, which adds to inflation. Right. So, I mean, that's just one example of how the Fed and their simply raising rates is not just the only answer, because there are many outside factors which are in play here. Right. And the war in Russia is a primary example of with oil and the price of oil going up. It's affected us, started to affect us a lot less because we have our own reserves. But what about countries that depended heavily on Russia and Russian oil? Germany.
Well, we talked on my channel. We talked a lot about natural gas because I'm very familiar with the oil and natural gas industry. Right. I think my audience is pretty well versed on this. And natural gas is a far more important part of the equation for that war, as it's been weaponized. Right. Oil a little bit less so, because all of that oil is still making it to the global market, even though there's sanctions. It's just going through a third party to do so. Right. That's the way, and it's just more expensive. It basically cuts into their profit margins, but it's all still making it to market. Where I think that Russia miscalculated so vastly is that it doesn't matter if every Russian soldier packed up and went home today. Vladimir Putin came out and said, "Hey, I'm really sorry. The Europeans are not going back to being dependent on Russian gas."
That's a lesson that was learned.
Yeah, there's going to be a massive fleet of liquid natural gas tankers that are going to be built. There's going to be new pipelines that are laid down all over Central Asia, avoiding Russia, going through other countries. And the other thing I think is, there's always been huge differences in prices between natural gas here in the United States and natural gas in Europe and natural gas in Asia. I think those differences are going to get smaller and smaller because the market's going to become more globalized. Right. And that's a good thing to reduce conflict. This is no longer a weapon that you can hold over other people's heads. Right. And this is one of the reasons why also that I've been a huge supporter of alternative energies and electrification of transportation. It simply removes one pillar of conflict out of geopolitics, right? We will no longer have energy wars if everyone can make their own energy. through solar, wind, geothermal, whatever sources they may have, and nuclear power, whatever. We don't have energy wars like that anymore. What does that do to the global economy? How are we able to benefit from that? How are we able to invest in that? That's kind of like all kinds of conversations that I like to have on this channel. So before we actually went live, you and I were discussing a move that Japan did recently that was not coordinated with the Fed. And I want you to talk a little bit about that, because that's actually saying something huge about why the dollar is so strong too.
Yeah, so I mean, the Fed's been raising rates, and it of course has an international impact, and it affects currencies and economies all across the globe, particularly poorer countries. But Japan, a very strong country, they've had their own issues, and they've been trying to get people to spend. Japan has been a country of notorious savers, so their interest rates are very, very low. Almost as low as you can go. As we've been increasing our interest rates, Japan is not. Their central bank has not increased rates there. So as a result, what you've seen is the dollar strengthen a lot versus the yen, the Japanese yen. So the buying power has increased for US dollar, and it shrank for the Japanese yen. Japanese have always prided themselves on their buying power. So up to this point, it really hasn't been that big of a deal. I mean, they've been kind of grinning and bearing it. But recently, I believe it was late yesterday, they said they had enough, and the Japanese central bank dumped a bunch of US dollars in support of the Japanese yen.
I mean, they went out and they purchased the yen on the open market.
Right. And that was right after the yen slid down 20%. Once it hit that 20% number, the bank said that's enough. We're going to have to try and buoy this thing or hold this thing up. And again, that was right on the tail of yesterday's meeting with the Fed and them raising 0.75%.
I did look at exchange rates the other day. Right now, Japanese yen is like a 142.4. And I haven't been to Japan in like 6 or 7 years. But the last time I went, I think the exchange rate was like 106 or something like that. It's been a 40% slide over the last 6 years or so. That's actually pretty significant.
Yes.
But if you notice on that previous screen that I had, Japan has negative interest rates on not just the short term, but going out to 5 years. Yeah. Meaning that you will pay the government for a 5-year bond. You won't get paid on it, which is just insane, right? Although we've had brief periods where that's true here too, but it hasn't lasted for very long. It's also not a consumer economy. Like you can't, when people get more money there, they're not going to go out and spend it. They have a long-standing culture of saving. I think GDP to debt there, or GDP to debt is something like 160% of GDP is what they have in debt. But almost all of that is actually owned by Japanese citizens. So the makeup of what their economy looks like and what our economy looks like is very, very different. They're also facing like a declining population.
It's a ticking time bomb.
It's a demographic time bomb. I know that some very famous people here talk about the demographic time bomb and the lack of, basically saying that we're going to have a declining population in the United States. There is no indication of that. Elon Musk is like the biggest proponent of this. And I think there's a sort of ulterior meaning when he says decline of population. I think we know who he talks about is declining, but that's not something I generally talk about on my channel. But I went back because he was talking about so much and like looking about the economic effects of declining populations. They're absolutely devastating. I started looking at the population in the United States, and there is no indication that the population of the United States is declining.
Even if there is, it is nothing compared to what's going on in Japan.
Well, and China too. Like China has what they
call
China
now.
The 4-2-1 phenomenon, where they talk about there's a generation of children in China that are just incredibly spoiled. They call it the 4-2-1 because you have 4 grandparents, 2 parents, and then 1 grandchild. And that's a result of the one-child policy. So you have this, like Gen X, Gen Z type of generation that's just absolutely hideously spoiled because of that phenomenon. But the underlying sort of assumption there is that that generation is really small.
Yeah.
And how are they going to support the generation that comes behind them, right? And how are they going to support the people that are in front of them as well? The older, they're a really top-heavy population that's aging very, very quickly. We could actually see just a naturally demographically driven decline in Chinese productivity because their population is aging so much and because they really miscalculated with the one-child policy. I think so. Doug B., who's a member of my Patreon and also a regular commenter here, makes a comment. Let's talk about here. It says he said good afternoon. He's very, very polite. He says, isn't there a disconnect with the Fed versus unemployment? Everyone is understaffed where I am, food, haircuts, even body shops. One guy running a shop by himself for a year. So the Fed's goal, of course, is price stability, right? And we always say it's inflation, but it's price stability and full employment. Well, when you enter an era like we're in right now, you're not going to get price stability along with full employment. The Fed wants to have unemployment. They're not coming out and saying it out loud, but when they say, and this is a direct quote from Jerome Powell, I wish there was a painless way to deal with inflation, but there isn't one. That's code for be prepared for unemployment. It's coming. And the most vulnerable people out there, the lowest skilled workers are the ones who are going to be hurt the most. The lowest skilled workers are also the ones who basically don't have any savings and they spend all the money that comes in as well. And it's the easiest way to tamp down on demand. And that's what they really want to do. They want to reduce demand by reducing the amount of money that people have in their pockets. That means unemployment. It's a really harsh reality. It really sucks, but this is absolutely the goal of the Federal Reserve. Now, do they want 1 year of 12% unemployment, 2 years of 7.5% unemployment, or 5 years of 5% unemployment? What if you had to guess, what would you think, Loren?
I'm not sure. I just think that there's room, as Powell said, there's room for unemployment to be lowered because we're at all-time highs in employment. So all-time unemployment lows. But again, that's one of their mandates, low unemployment and 2% GDP. So, I mean, if you have to reverse and increase unemployment right now, that's going to be one of their goals. If nothing else, to increase unemployment so that it's because right now we're well under the amounts that is their mandate.
Absolutely. Like if we had 5% unemployment, that's still 5% unemployment would be higher than we really had since roughly 2013, right?
Right.
We had average 5% unemployment, but that's still lower than the 70s, the 80s, and the 90s, all of those average unemployment rates.
Right.
So you're looking at many points in the 1990s, which we think of as a great economy, unemployment was actually over 6%. And a lot of people just forget that. And then we had peak employment participation essentially in the year 2000. It's declined every year since. And part of that is just baby boomers are retiring and they're the largest, bubble in our population group here. But I think that there's not necessarily a disconnect. That's not what I got out of listening to the Fed and Jerome Powell talk in the last couple of days. Everyone is understaffed. And it's not that there just aren't bodies out there. It's that all of these bodies that could be working in food places and haircut places and body shop places, they have jobs right now with benefits at $22 an hour in a warehouse working for Amazon or something like that, or working at Costco or anywhere that's better than those places. And because labor is a market, and I know this from owning a bar and restaurant. Labor's a market. You have to pay now to attract workers. Everyone that keeps saying, hey, people don't want to work. I'm like, no, it's not that people don't want to work. It's just they found a better job somewhere else with better benefits and more pay. And you can't hire anyone at the wages you wanted them to work for you at 5 years ago. You just can't do it anymore.
Right.
And that is one of the factors that is pushing wage inflation as well, is that the economy has been so good that all of these people who we've been telling now for the last 2 decades, get a better job, get a better job. They went out and got better jobs. And now they don't want to go back and work for minimum wage or whatever you think is, or I think is a fair wage. It's one of those employers actually. So that's pushing wage inflation as well, which is pushing demand, which is
pushing
outstripping
general
supply
inflation.
chain. Just
It's
everything.
adding
Pushing
to regular
general
inflation. Yeah.
It's and the saddest thing out there is that the people that needed this reorientation of how we pay people in the United States, they're going to be the ones that are most hurt by what's coming next.
Right.
Absolutely most hurt by, because they're going to lose all of their pricing power in the labor market when some of these entry level jobs that they took, as a entry level whatever, when those jobs go away because some of these businesses go out of business, they're going to be forced to go back to that restaurant or forced to go back to cutting hair or working in the in a body shop or something like that. Which body shops have traditionally always had trouble getting labor though, because that is actually skilled labor. But they've always had trouble getting really good labor and keeping labor. But eventually, when some of these startup companies these people work for, or these positions at these better companies where they had great benefits, they decide to go ahead, hey, we're going to cut back, because we've seen this already, especially in financial firms. Oddly enough, they're always some of the first people to say, hey, we're cutting back on our labor expenses. And they get rid of some of their higher paid employees that they now see as redundant, or they get rid of some entry level positions because benefits are really expensive for them. In that case, you're going to see, like I said, a lot of folks that had cushy jobs with great benefits are now going to be pushed back into manual labor or to lower paid labor. And I think that's terrible. I really do. And it's, like I said, it kind of, you see this resurgence in unions right now. And we've seen that, right?
There's a reason.
There's a reason. It's because labor has pricing power right now, and Fed policy is going to mess that up. And I wish this event had been less sharp and more longer lasting. And as a business owner, why do I want workers to earn more money?
So that they can stay. I mean,
Well, so they can spend money in my business too.
That too, and so they can spend money in the economy. But
yes,
the thing can, of course, spiral out of control. You raise wages, and pretty soon, if everyone is making more money, then the prices are going to adjust themselves for that. And a few years out, then you have to raise rates all over again, wages all over again, because the wages that you've raised have become ineffective because the prices of everyday goods and services have gone up as well and commensurate to the wages. But you know what? It's the natural order of things, and this is the way things are done. Even what we're going through now, cyclical, right? So through the 80s and 90s, unions were a horrible, horrible thing. But now the pendulum is kind of swinging the other way. People are finding value in.
I think we made a big mistake.
Unions.
I think we made a giant mistake with the anti-union culture in the 1980s and 1990s.
Yeah, I mean,
it's good to be critical of unions. It really is. Because a lot of them, especially on the East Coast, were just like corrupt institutions run by the mob. But labor hasn't had any representation really since the 1990s, and it's really shown. We've seen a widening gap now in wages between labor and management, and labor and ownership. So, and Doug says, nice to be in a critical union like train workers right before an election.
Right.
Yeah, but you should watch the videos, Doug, on some of the working conditions that railway workers have right now. One of the big issues with railway workers is that they just haven't been able to replace bodies fast enough in their business. It's unsexy and unglamorous. It's not a career that anyone pushes themselves into these days. It's actually fairly well paid, but their hours have gotten ridiculous as the older population in that industry has retired, and they haven't been able to replace them fast enough. Merchant Marines is another one of those where I will not be surprised to see some labor disruption in the Merchant Marine fleet, because they've been worked like dogs now for like 3 years. Their wages haven't kept up, and a lot of their older members are retiring too. They're not able to replace people retiring.
I think Doug brings up a good general point in that, there's newfound power in unions, voting power. People group together workers group together around a cause, they're able to assert power.
Yep.
And I think that's what a lot of groups in this country are looking to do when they see that their interests are kind of being neglected, whether it's true or not true. But as far as workers are concerned, there's a big disconnect. I mean, let's face it. With companies, we've seen companies' revenues growing quarter over quarter because that's what stockholders want, right?
Yeah.
If it's a growth stock, they want to see revenues increasing quarter after quarter, and that's not really natural. I mean, that whole system needs to be revised, but that's what we've been seeing for the past 10, 15 years. That's what's become popular. And in order to do that, you're not raising your wages enough for your workers. You're not giving them probably what they should or what they've had in the past. And that's the kind of environment we've had within at least the last 20, 25 years. And, maybe we need to go back to an environment where the profit margins of many of the companies are a little bit tighter. I mean, what do you think?
No one's going to put up with that, man.
No one's going to put up with that.
No one's going to put up with that. Are you kidding me, man?
Sky,
heads would roll. I mean, CEO heads would roll, metaphorically speaking, of course, not literally.
Right.
Yeah.
Right.
Let's address one question here. It says, this is from Patrick Mulligan. It says, regarding crash or recession, what is the best tactic? Hold, buy more, or sell? I think if investors at least held, the market eventually recovers. So
I think that's true.
We can talk about what people feel like they should do. We can talk about what people will do. And I can tell you, based on history and statistics, what is actually the best course of action. You're going to make more money by investing right now by buying or by doing nothing. Trying to time your trades, jump in the market, trying to sell now, save yourself some short-term pain to get back into the market later when you think everything is better. It almost never works out. And there's actually reams and reams and reams of academic research that has been done on this, tons of papers that are written on this, rolling studies going back like 40 years, like back testing data all the way back to the 1920s. Market timing, if it works for you once, it was just luck. The problem is it's going to convince you that you're a really genius trader or really good at timing the market. And you're going to keep trying to do it over and over and over again. And eventually what's going to happen is you probably end up underperforming the market. What you're really looking at when it comes to actively managing your accounts is tactical asset allocation, meaning not necessarily buying and selling in and out of individual stocks, but underweighting and overweighting to sectors based on where we think the economy is going. And this is something that Loren specializes in at Client First Capital. I talk a lot about individual stocks on my channel because it's very interesting, but I've said numerous times that 70% of my investable net worth is actually just in ETFs, and I really don't do anything with those. I just buy more, right? 70% of my investing is so boring that I don't want to talk about it, right? But it makes plenty of money on its own. It has a great deal more stability than my individual stock portfolio. In my individual stock portfolio, I almost never sell. I'm pathologically adverse to paying taxes. So I almost never sell, so I don't have to. But I've made most of my money investing by doing nothing, by buying and then not thinking about it, addressing, looking at it, prognosticating on it whatsoever. I do mostly buying. And sometimes it's only 1 or 2 shares at a time because that's all I can afford. And if you have extra money now, if you had extra money starting in June, now running through the end of the year, I think 5 years from now, you're going to be very, very happy. And it pretty much doesn't matter what you buy, right? So, I mean, that's my opinion. Loren might feel differently.
No, I agree with you wholeheartedly. It's just that when you talk about individual stocks and the buy and hold strategy, that over time that is the way money is made. You just have to concentrate on buying the right stocks, good solid companies with good solid balance sheets and good business practices, and you keep buying those companies, make it, get in a good position in there and keep buying a little bit more over time, and don't sell it. I mean, all this buying and selling and getting in and out of stocks. Even the so-called experts and the hedge fund managers and the like, even they don't, win a lot of the time.
They don't outperform their index. They don't. I can tell from the noise in the background. You're at home.
Yeah, sorry about that.
Yeah, with your parents or something. Yeah, instead of back home in New York. So, yeah, mom must be cooking lunch for you or dinner. So
yeah, hold on 1 second. Let me cut out for a second. Hold on.
Yeah. All right. So, I didn't actually mean for him to cut off and then go tell his mom to like not do the dishes or something. I was just kind of like noting that anyway. Yeah, I think that Patrick, that holding in your case is probably the best course of action. If we said feeling the need to do something rather than nothing is really sort of the beginning of underperformance. And you can go back and look at something called the SPIVA persistence report over time, and it's done by S&P, right? The SPIVA persistence report is a report that looks at how professional money managers are measured against the market in general. Okay, that is, and it's really amazing to see that in any 1 year, about 88% of professional money managers underperform their index. Furthermore, if you look at whatever's in the top quartile, meaning not even all these funds outperform their index, but whatever's in the top 25%, the top quartile there, if they were in it for the last 5 years, it is virtually a guarantee that they will not be in it for the next 5 years, which is like all of those Cathie Wood funds that were in the top quartile of fund performance, or top 10, top 10 fund performance for over a 5-year period, guaranteed they're not going to be in it for the next 5-year period. In fact, there's a significantly higher chance that they're actually going to be in the bottom quartile. When I say significantly higher chance, the last time I looked at the SPIVA persistence report, I think was in March, and it was 56%, meaning that if you were in the top quartile in the last 5 years, there's a 50% chance, 56% chance that you're going to be in the bottom quartile for the next 5 years. So I thought that was pretty interesting. So yeah, and that's been consistent for like 30, 40 years since they started doing the research. Nathan Gardner says, hold on, guys, buy stuff you like that has gone down with a long-term outlook. That's pretty much it, Nathan. For everyone that thinks they're in an investment genius who's made a couple $100,000, there is an investment guy who doesn't think he's a genius, who just bought stuff that he likes. Those are good companies with good, solid business practices and had a long-term outlook. And just having a long-term outlook in a lot of cases will make it to where you make a lot more money over time. Any particular stock's performance in any one day is absolutely statistically irrelevant in most cases. And even the market moves for any one particular day are statistically irrelevant when you look at, things in like decade-long slices. The amount of times the market holds on to a gain in a 10-year period, 20-year period, it's usually only like 10 or 20 days in that entire 20-year period that the market actually holds on to a gain and it becomes statistically significant. There's another long research project that's been going on with multiple companies called the best 10 days of the market. I've done videos on this before. Nobody cares. Nobody likes the video. Although I thought it was some of the most fascinating research I've ever read. But essentially, I first read it in 2005. So the research is going all the way back to 1985, where Fidelity determined that the market did 11.3% from 1985 to 2005, but the average investor did 3.8%. Why was that? And so there are all kinds of, was it taxes? Was it fees? Was it commissions? Was it this? It all boiled down to this: investor behavior, bad choices with trades. Underperforming the index was about being too active. That's it. It was about making too many trades. Doesn't matter how smart the guys were. Doesn't matter how dumb the guys were. The people that were the most active traders actually dragged down the performance for all of Fidelity. And it didn't take much. If you were out of the market, they figured out over a 20-year period that if you were out of the market 10 days from 1985 to 2005, I don't remember the exact days, then your return went from 11.3% down to 3.8% by missing only the 10 days best days in the market in a 20-year period. Okay, so that's anomalous, right? Actually, it's not. The numbers have been relatively similar ever since 2005. They've been doing rolling studies on this, and it's not just Fidelity. It's every company out there that's done it right now that does research, and they found out the same thing, that in any 20-year period, there's really only a few days, like 20 or less, that are really statistically significant and are going to drive gains in your portfolio. And if you're out of the market in that period, it damages your return for that entire 20-year period.
But Jason, you make it sound so easy. I mean, part of that is that the reason why investors consistently behave that way is because it's emotion.
Oh, yeah, don't have emotion.
It's your hard-earned money.
Don't have emotion.
That's in the market, and it's like you see that you're about to go over a waterfall. I mean, the natural impulse is to jump out of the boat, right?
Yeah.
Not to stay in it. And that, if you stay in the boat, it's the safest place to be.
It's a natural impulse.
It's a natural impulse.
It's wrong. And the market is not built for human beings. No. It is a transfer mechanism. I forget who says this. Basically, it's a transfer mechanism from basically people who are impulsive to people who are patient. That's all it is. It's a wealth transfer mechanism from people who are impulsive, who like to trade frequently, to people who are patient. That's all it really is. I forget. I mean, it may have been Warren Buffett, but I don't know who said that. And I'm paraphrasing, of course. That's not exact. So
it's accurate.
It is accurate. It is accurate, though. And that's you are correct, though. I make it sound so easy, and it's largely because I learned the hard way to take my emotions out of investing. I still get invested in a certain company when I look at it, but my bottom line is always, is the company growing its profits? I don't believe in the company. I believe that if they keep growing their profits, the market's going to catch up and start paying attention to them, right? So let me see here. Doug B says, an opinion on bear ETFs such as SQQQ in these times. Bought some a couple of weeks ago. So far, so good. At least this is a hedge for a while. Maybe swing trading the rest. So, Doug, I hope you're in and out of those funds kind of on a daily basis. Those leveraged funds, those leveraged inverse funds, are not meant to be held over a long period of time. All it takes is one or two really bad days, and when the market goes up instead of going down, one or two like really, really bad days, and you are actually never going to make your money back, and it's due to something called time decay. Did a video on that a long time ago. It's a really complex topic. The math is actually really easy, but it's a complex topic, difficult people to understand. Nobody cared about it. Nobody watched it. I literally got like 30 views, so I took it down. But if I have it, I'll post it up on the Patreon group. Let me see if I still have that video around. I'll post it up on the Patreon group. But it actually will tell you kind of how you should handle owning these. It says right in there in the prospectus, because I know, like, you read the prospectuses, right? Like I do, and like Loren does. You read the prospectuses, right? When you read those, it'll say right in there, not meant to be held long term. So, yeah.
Everybody reads those, of course.
But yeah, I do actually, because I'm just a nerd. So actually, I have read the prospectus of every single financial product that I've ever purchased, every single one.
Nice, it's nice. Nice toilet reading material, I guess, if you do that.
Pretty much.
Well, I mean, it's necessary, and you know what? Not for nothing, it should be read, but no one does. Very few people do it, or they may just go to one section. Let's go to the fees. How much are they charging me? Oh, they use it as a point of reference. But the general prospectus on most of these packaged investments should be read.
It should. Yeah. Even with ETFs that are traded like, they're traded like stocks, you still need to read those prospectuses. It's not
there
just
are lots of leveraged ETFs, and one, especially in the fixed income area. So.
Yeah, so a lot of people are going to get confused with like QYLD and like XYLD and what was the QYLG and all those. Like, they're really going to be disappointed when the market turns back around. And those are those covered call funds, right? They're really going to be disappointed when the market turns around and the price of their fund barely moves. You're selling in the money calls, guys, right? And right now they're distributing money, at still like an 11 or 12% rate. They're not making 11 or 12% right now selling in the money covered calls. They're not making that right now, especially as the market is declining, and what they're hedging on is declining as well. When the market finally turns around, those shares are going to get called away. They're going to have to buy it right back tomorrow at a higher price. They can continue to distribute money to you that they didn't actually make, which is what the funds are doing right now. And it says right in there, it's not a dividend, it's a distribution. And a distribution can be principal, it can be premium that's generated on owning these options, whatever it is. And they're really, really going to be surprised that these funds are down 25, 28% from their peaks. And they're not coming back when the market roars back 25, 28%. It's going to take them years to come back. So, I do need to answer one question here on an individual stock. I know you can't say anything about this, Loren. So, Xpeng keeps going down. The net is a huge negative. The products are great. I put almost $400,000 into it at $41, huge pain. Do we have any hope of it getting back to $40 per share? The short answer to that is it depends on your time horizon. Xpeng is a good company with a great manufacturing strategy, with the ability to build factories quickly, with a market where they can sell everything they can produce. They just can't produce much right now because they're located in China. The supply lines are being disrupted, but they don't have a problem with sales. What they have a problem with is producing enough, and they have supply chain issues. When do they get back to $40? I don't know when they get back to $40. I think that's 100% highly likely that they will. Notice how I said that, 100% highly likely, because I can't guarantee anything. But it's highly likely that they get back to $40. It just kind of depends on what your time horizon is. I did notice at the beginning that you said somewhere that you may have put like your house payment down on this, or your like down payment on a house. I hope you don't have a short time horizon on that, particularly right now with the way real estate is going. Waiting may not be the worst thing that ever happened right now, but does it get back to $40? Does it get back to $60? Does it get back to $70? I think it does eventually, but it's when the actual sales numbers catch up to the growth expectations for Xpeng. This electric vehicle maker has a great future, and I think that a lot of people don't understand what I see about this company because I'm really bad at communicating it, but it is their ability to rapidly build factories and their expertise in manufacturing and the great products they have that is actually going to, and the fact that they're not encumbered by all of these relationships with governments, like some local governments, like other companies in China are. This is one of the things that's going to lead them to the path of success in the future. It's going to take a few years to get there. I think my average cost on that is something like $26 a share or something. They're down to $15 a share. So I am hurting there, but I didn't put $400,000 into it. So, but I hope that gives you a little bit of hope that I am not selling. I did end up selling most of my NEO stock at this point. But I bought that for a ridiculously low amount. So, anyway, that is the one question I needed to address there. But there's the one like individual stock question I need to address. He had something on there in the beginning. Let me see if we missed anything else here. So I haven't read why that was downgraded, Steve-O. I need to take a look at why that was downgraded. We're talking about Block here, and whether or not I see the stock recovering. I actually see a huge risk in Square. Even though I own Square, I see a huge risk in Square right now, and it's this pivot to blockchain. I have no idea what's going to happen with blockchain technology. I have some ideas of what's going to happen to blockchain technology that won't be monetized, right? Like, Lauren, I don't know if you saw this or not, but almost all of the evidence for Russian atrocities going on in Ukraine right now, it's actually being stored on the Ethereum blockchain and a couple of other blockchains.
I'm not surprised.
Because of
one of the only evidence they would have.
Yeah, well, it's because of its permanence, right? You can't get rid of it. You can't edit it. You can't. But how is that monetizable? How does that make a company like Square that's making this huge pivot to blockchain? How does that make them money? Right? I don't think it does.
I think that some things have to happen for it to happen, and they're banking on things going their way. I don't know how
Yeah,
that's
you're
going.
not a blockchain guy. I know we've had this discussion before in private. Like you're not like a blockchain guy.
No, I
And
mean,
most,
I believe in the technology and it will be used for something. But as far as cryptocurrency, I think that's you know um, in and of itself. I don't think it's the way to go right now. I mean, when you talk about cryptocurrency, you're talking about a currency floating, a free currency floating currency,
yeah, we
not
get the
tied to
same
any kind
argument
of
every time.
economy or anything else.
Getting the same argument every time.
Yeah, I
The,
mean,
the
there are
U.S.
pros and
currency
cons
is
to it.
backed by nothing.
Right, there are pros and cons to it. People can say that about the dollar, but
Yeah,
people believe that the dollar is something, and none of these cryptocurrencies are there yet. Could it happen? Yes,
yeah.
but it's not going to happen with a track record of 12 years of being around only 12 years. It's taken a lot longer for the dollar to fit into that category. But long story short, while there's consternation and arguments and mystery around these things, you're going to have nefarious activity take place when
Yeah.
there's little or no oversight. And if something happens where a government like Russia or someone else is kind of blocked from all the different currencies out there, why not go
Oh
to
no, that's not what I was talking about. I was talking about the digital evidence of all of the war crimes and atrocities in Ukraine.
right?
That's being stored on blockchain. So all of the images, all of that stuff, that's being stored on blockchain. That's something that I didn't anticipate, but that is something I think that is really going to add to the permanence and legitimacy of the record. I'm not saying that it had to be horrible stuff like this, but it's going to be used in evidence in war crimes trials. And
I believe in blockchain. I think that you seeing this as a different use. There are other uses that we just haven't even thought of yet.
Yeah.
So
No,
I just talked about cryptocurrency because I know that was part of it. But while I may not necessarily be a fan of cryptocurrency, I am a fan of blockchain. I do think that is the future.
Yeah.
Yeah.
I do too. I think that as a transaction record, as one that really can't be interfered with on a couple of different levels, and that is democratized to a degree. I think that is the future of many ways in which we exchange value around the world, across borders, without regard to currency. This is how we exchange what one human values to something that another human values across the globe, where we're not even using currency. Like the cryptocurrency is just our medium of exchange. It's not the traditional ones, that the fiat currencies we would have used. And I know people always talk about how it's anti-inflationary and all this, but it's not. That's not really the point, because it's endlessly fractionalized, right? Think about, if you go out, you can go out and buy $10 worth of Bitcoin right now, and it just could be endlessly fractionalized, right? And you're still gonna, and until people aren't thinking about it in terms of how many dollars is this Bitcoin worth, it's never really going to be the currency of choice, right? Like I know people still. Hold on a second here. This is actually a really good question to ask or to answer right here. But I'm going to do one little thing on blockchain. Everything that's happening right now on blockchain doesn't say jack squat about how it's going to make the value of the tokens used on that particular blockchain rise. How do those become more valuable? Nothing about what's happening in business right now makes those become more valuable. They're only valuable right now because people believe that they're valuable. That's it. People have assigned a value to them. And that's one of the things that until the sort of value stabilizes to a degree, or we have something to bounce it off of and really compare it to in terms of cryptocurrency, I think that it's still going to lack in terms of actual financial transactions. And I think it's something other than finances that ends up becoming the transactions of records on blockchain that are going to be most important. So,
absolutely.
Yeah. But let's talk about it here. So George Chioda says, and I think he's from Greece, could we see a bank failure like the Lehman collapse in 2008 and years to follow? Asset prices have indicated to go lower, something like that, or nukes, everything without an incident like that or nukes, everything will be fine. Well, okay, like there's the black swan events, of course, like a nuclear weapon, even a tactical one, changes everything. There's no way to predict what's going to happen. Like even I feel like sometimes the media has been trying to prepare us for the, trying to prepare us for the use of tactical nuclear weapons in Ukraine, saying, oh, it's not going to be that bad. It's only like a few square miles of territory completely vaporized. No, it's an unconscionable escalation in the war in Ukraine. Ukraine, under no circumstances would they pose an existential threat to a country the size of Russia. Under no circumstances. If they used tactical nuclear weapons in Ukraine, it would. I don't think our response would be as measured as President Biden indicated it would be. I think it would be a lot less measured than that. And I think it would be terrible for everything. And there's no way to predict what would happen other than, I don't know, maybe work on your caveman skills, because if nuclear war really kicks off, there's not going to be anything left. Like don't worry about what your investment portfolio is if we have nuclear war. So but could we see a bank failure like Lehman in 2008 in the year to follow? So banks do fail all the time, right? And it's just you don't hear about it most of the time, and because they're backstopped by the FDIC. The FDIC usually arranges for those assets and deposits to be sold off at a discount to a willing buyer. You just don't hear about it. Or they're acquired right before they're going out of business anyway at a discount for something like that. The Lehman Brothers failure was really a failure of scale. It was just the largest bank that we had seen collapse like that. And at that point, the government refused to step in. And they only stepped in after that because they saw a systematic collapse. I think we're going to see some bank failures here, right? Think about how much risk banks have taken on commercial loans in particular in the last 5 years with almost no reward because interest rates have been so low. So that's kind of my position on that. We're probably going to see bank failures mostly on the backs of some of their commercial loans, but some on the backs of again securitization of housing loans. I think what's most interesting though is you have states like Texas right now where 29% of all real estate period is corporate owned. Right? It's one of the reasons that real estate in Texas has shot up so much in the last couple of years is because 29% is owned by corporations. Who are those corporations? Goldman Sachs, TD, Morgan Stanley. It's not property developers. These are just like investment. So what are they going to do with those homes?
I don't know if there's going to be if bank failures are necessarily a prime threat. I think everything is on the table, but notwithstanding, what's likely to happen? I think that the Fed and the government is likely to relax certain requirements and make things a little bit easier for banks to operate if things get a little bit more dicey going forward. We would, if banks fail, you're talking about another crash, like we were talking about earlier.
He's talking about a bank on the scale of Lehman. I don't see that happening this time.
Well, no. Even the way Lehman happened, look, I don't know what you think of banks, but the banking industry, anyways, is kind of like a religion. It is it's a belief system, and if you lose belief in the system, then everything goes up in smoke. People lost belief in Lehman, and there was a run on the bank. Pretty much, people were saying that they didn't have enough money to cover, their deposits. When Lehman was saying that we do. Well, even if Lehman was right and said that they do have enough to cover their deposits, if everyone's taking their money out and saying, hey, don't be the last one, cut the light off or whatever, then it's going to become a self-fulfilling prophecy. It happened to Lehman at that time, but the landscape was ripe for it. I don't see the landscape being ripe for another Lehman at this point.
Well, and I think Lehman happened because it was allowed to happen.
It was Right.
Because they're so heavily involved in investment bank, like a company now like that was so heavily involved in investment banking, they would not be allowed to collapse in a disorderly manner like that. They would be chopped up and sold. Like AIG was chopped up and sold by the Texas Insurance Commission.
Overloaded and CMOs and CDOs.
Yes, yeah. So that's not happening as much anymore. The other thing that's going on, like the bigger surprise to me was Washington Mutual in that time period. Like Washington Mutual, like if you're outside of the West Coast, you might not know who Washington Mutual is, but they were a massive regional bank with hundreds of billions of dollars on deposit. They were actually in fairly good financial condition. And I knew lots of people. I knew a woman who worked there who had her entire life savings in nothing but Washington Mutual stock.
Wow.
She got wiped out. Completely wiped out. So it was that was her entire life savings. It was I know it was somewhere north of $500,000 because when I saw it was already $500,000. So and that was a few years before the crash. But she got completely wiped out. I remember having a conversation with her. I was like, "Hey, really bad crap is going to happen. You might want to think about moving to cash or diversifying." No, it'll come back. It always comes back. And this is actually kind of reminiscent of some conversations I've had with people today who are not necessarily clients of Client First Capital, but just like people randomly that I've had conversations with telling me about how much money they've lost in the market. They're losing a lot more than what's in the market. And that's reflective of them not being diversified. There are too many tech-only investors right now who aren't prepared for the really wild ride that tech is going to give you when the market goes down. And, I am, so I'm a tech investor. A lot of people, this is the last time they're going to be tech investors. But no, like, the Washington Mutual in that case, though, they weren't heavily involved with all of these collateralized debt obligations. They didn't have, they had like a basic housing portfolio that was a little bit overloaded in terms of their their subprime mortgages, but it wasn't that overloaded. But they had exactly what you described, which was a run on the bank. A rumor got started that they couldn't cover their deposits.
That's all it takes.
But they were well above their reserve requirements. They were well capitalized, and that's all it took. Within a couple of days, they were gone. So, like IndyMac, not a surprise. In an age when there weren't that many online-only banks, they were an online-only bank. They were like the first one to go out of business. And then after that was like Lehman, and then after Lehman, like 2 months, 3 months after Lehman Brothers, when Washington Mutual went under. That was a big deal, man. What was it? Torrey Pines National Bank here ended up buying up 6 or 7 regional banks that got into trouble. And it was basically because of the same thing. They were ostensibly in pretty good condition. They had securitized their subprime loan business and moved it off their books and sold it on the open market. The problem was they went back and bought those same types of loan portfolios from other banks and put them on their books, right? After they're like, this is too much risk for us to have on our portfolio, right? We're going to sell it. They went and bought those as investments, the same type of thing that they just collateralized. Not realizing, of course, that if they put a bunch of subprime mortgages in that, wouldn't everyone else do the same?
Right.
Those concerns, they're not gone at this point. They're not gone, but they're just different. Here's a question. Al Lubis says, thoughts on physical gold at 1650? I'm going to say something real fast. I'm completely biased against gold. Completely biased. And I can't give you an objective answer. Yeah, I can't give you an objective answer on that because you can't eat it. It doesn't produce a dividend, and it's not going to compound. So it's not an investment. It's a placeholder. It doesn't stop me from having actual physical gold in case I need to take my family and run out of the country.
It's still a medium of exchange, and it's still
a medium of exchange.
It's still,
but I hate it because it's not really an investment. However, so this is the reason I can't talk about it as an investment, Al. I just want to admit where my biases lie. Maybe, Loren, you have something to say on this.
Well, yeah, will it go to that price range? It's possible. I don't think it's that likely in the shorter term. But, it is an investment. It is a medium of exchange. It's a valid investment in that it is something that people buy.
Gold is at 1671 right now, so.
See, what was the amount that he was asking?
1650.
I could. Yeah. You mean dip below where it is now, basically, right?
Let me see here. Let's look at that. I haven't looked at, like I said, I'm so biased against gold, I don't even look at it.
Yeah. So
it hasn't done that much since 2020. It's like the SMA here is like 1830, so it's below. It's at 1671 right now. So yeah. So the 200-day moving average is like 1830 over that.
could it go to 1650? Yeah, it could.
It could. I think he's saying, would you purchase it at 1650? If you purchase at 1650, and I'm looking at the last 2 years, remember, guys, I'm not a huge believer in technical analysis, meaning that the academic research doesn't support that technical analysis is that useful. Although looking at this here, I'm looking at the 200-day moving average here since October 21st being 1830. Purchasing it at 1650 might not be a terrible thing.
I would be an advocate of holding it, of buying some at that level, but not in the, with the goal of making a killing or making a quick profit. I think gold belongs in most portfolios, even if it's at 2 to 5% of the portfolio. It's a good hedge, and it belongs in a portfolio, I believe.
I keep a few $1,000s in physical gold for the sole purpose of, what if everything goes to hell and I have to leave the country with my family and get restarted somewhere else? That's the only gold that I have.
That's why it's an investment.
That's why it's an investment. Yeah. Well, I mean, it's because it's something that's universally recognized.
Right.
It's one of the, basically it's, I don't know if it's one of the oldest lies, but it's probably one of the most successful lies in the entire on the entire planet.
You said lies?
Yeah. Think about it. Before it was recognized that it was a conductor, it didn't have any uses. You couldn't use it for a tool.
Right.
You can't like before. Technically, I guess you could use it for a bullet. It's a really soft metal. It would work, but we didn't have bullets when suddenly someone decided gold was valuable. You can't use it for a cutting tool. You can't use it for anything. It's useless. It's such a soft metal. It's not useful for anything except pounding into really, really pretty jewelry. I think lots of metals make really pretty jewelry. Is it rare? It's kind of rare, right? But what makes it valuable, other than the fact that other people think it's valuable? Today, it has industrial uses in electronics, especially, right? And in circuit boards. It's
right. Why is that?
Because it's a conductor.
It's a conductor, so it does have some value, conductivity. Right?
Now it does.
That's
it does.
Huge.
But before we had the age of electricity, why was it valuable?
It's pretty.
Because it's pretty, right? But this is a lot of things in our economy. Like I was just talking about Dutch tulips to someone, comparing NFTs to those. I'm like, this is another Dutch tulip moment. You guys watch. Like NFTs do have a usefulness in our economy. They will have a usefulness in creating digital uniqueness. But your Bored Ape is not going to be worth $500,000 next year. I'm sorry. It's not. Nobody cares about the history of the community. No one's, and this, I'm going to lose some subscribers over this, but I don't care about the history of your Bored Ape community, and most people don't care about, and they won't. They're going to move on to something else, whatever's next and new and shiny. But this recurs in our society over and over and over, where we have something that we suddenly decide is valuable because of the story that goes along with it. This goes back to, was that Yuval Harari? Yeah, the guy's always talking about. Have you ever read *Sapiens* yet? By Yuval Harari? Great book, by the way. But he talks about, he says that they're stories or they're narratives that sort of shape human civilization and human society. He's being really euphemistic. It's lies, and it's cons that have essentially shaped human society and what we view as valuable in our society. And it changes so rapidly. There's very few really permanent lies that have stood the test of time. Gold is one of those. Currency in general is one of those. I can't give a cow $400 and say, or $100 and say, you can go out and buy 400 bales of hay. They're not going to accept that as payment. They're not. It's like the cow wants the hay, right? You can't do that. But we have these recurring lies in all throughout economic history where we suddenly decide something is valuable. Last year it was NFTs. It's been cryptocurrencies for a while. I will give you guys that a couple of them will end up being permanently valuable. But the other 18,000, and there's literally more than 18,000 cryptocurrencies out there, they're absolute crap. They're worth nothing. They never will be. They're just callous scams to take your money. That's all they are. And there's going to be 4 or 5 of them that are actually that actually sort of evolve into really useful networks with great value. And it's probably the names that we already know. Maybe, I don't know. They could be replaced by something new technology. That's one of the things I'm really afraid of, is that all the value that's being invested in these cryptocurrencies now and these blockchains, they're all going to be supplanted by something that's newer and better.
But that's what usually happens, though. When you're talking about a new invention or a new, and the invention stays around, but the early players usually, the chessboard changes.
Yeah.
So.
Yep. Doug says, isn't gold running the inverse of the dollar right now? The dollar is running hot, right? Meaning the dollar is getting more valuable and gold has decreased in value. Yeah. So the idea, Doug, look at this. Over the last 2 years or so, this is and if we're looking at inflation running at 8.5%, 9%, and gold is supposed to be a hedge against inflation, and we're looking at, since April of 22 to September 22, inflation is at 8.5%, 9%, and we've seen gold decline in price because the dollar is strengthening. Is gold a hedge against inflation? Like I said, these narratives economic narratives in particular, get stuck in people's heads, and they don't really look at whether or not there's actual correlation between the two, whether or not they're actually linked, and they aren't. It's like, I have gold in my portfolio, not my investment portfolio, but like just for like escape reasons. But there's a lot of people that have gold in the portfolio, not because it's a hedge against inflation, simply because it's a hedge in general. It's an asset class that doesn't act like stocks. It doesn't act like bonds. It doesn't act like your currency. It has its own behaviors. Like this right here is not correlation with inflation. It's inverse correlation with inflation, right? So it's getting less valuable as inflation is rising. This is the sort of opposite of everything you've been told. And this is a real short period to look at. When you look at it longer periods and you're trying to find a mathematical correlation there, that just really isn't one that you can point to that they're directly correlated. It's a great hedge, but I wouldn't depend on it being a hedge against inflation. Just like cryptocurrency was supposed to be a hedge against inflation, we've all seen that it's not. Gold is the same way, but this is a story that I have to keep, or a conversation that I have to keep having over and over and over the last 20 years in my financial career, because people don't understand the narratives that you're programmed with versus the actual data that you should be looking at. And that's one of the big things I want to talk about at some point. So, Loren, I can still hear you, although your camera's off.
Sorry about that.
What happened?
No, sunset.
Oh, calling your dog?
No. The sun's going down.
Oh, the sun's going down.
It's distorting the.
Oh wow.
The lighting.
Man, you're way up north too. Okay.
Yeah.
Yeah, I'm
on the other side of the country there.
I'm in sunny Southern California. It's only 2 o'clock here. It's still sun out. I don't know what it's like to, like, I remember when I lived in like when I first moved to Europe and it got dark like at 3 o'clock in the evening. I thought I was gonna die. So I was like, I can't live without sun. So I thought the world was coming to an end. Hey man, it's been an hour and 15 minutes. We've been on a little bit longer than I thought we would be on. So I'm gonna go ahead and hop off here. And I wanted to say thank you for coming on today. I want to have you on about once a month to talk about more global issues.
Sure.
Somebody here is going to email me and tell me that I didn't do a very good job of interviewing you today. So I'm going to get better at that, I promise.
Well, thank you so much. It's been a real pleasure to be here on your show.
Yep.
I look forward to future meetings and
awesome.
And to everyone out there, hello, and hopefully you've gained something. Hopefully I've helped.
And I'm going to be doing a once a month with Amar. Also, we're going to be talking about strictly financial planning issues.
Right.
And I think it'd be useful to do that with you too. So I said I'm kind of turning the channel a little bit more serious and focused in terms of like how my audience could actually improve their financial lives. A lot of them are just focused on buying the next great stock. I want them to be focused on improving their financial lives, growing their wealth over time, because that's usually what happens. You can't get rich quickly. You grow your wealth slowly over time. Right. But anyway, thank you very much for watching today, guys, and we'll see you next time.
Thank you, everyone.
All right, and we'll be off in 3.